Thank you for watching Next Day Pricing. My name is Dave Bontempo. I have been in the investment industry more than 30 years, most of those years as a trader. And I'm moving towards semi-retiring, and I say semi only in that I love the business. Don't think I'll ever really truly get out of it. But along the way, I have developed some unique methods and algorithms of my own, which I want to share with you, and they are unique. Not that they are, say, better than anybody else's. You give me 100 successful traders, and I will guarantee you that they all do something uniquely different from the other. And so that is just to say that I do have something that I think you will find interesting and very useful in order to improve your trading and reduce your risk on entries, increasing your profitability. Specifically, at the end of every day, I can calculate with a high degree of success and probability, both to the upside and downside, price levels to which the market, in this case, in this conversation, ought to gravitate toward. And again, I want to emphasize as we go through this, these are not price support or resistance levels. These are price levels to which the market ought to find itself aggregating. Now, after it has gotten to that point or points, they can be treated as additionally as support resistance levels. But at the beginning of the day, historical price support resistance levels may be totally irrelevant. And I think you will see that as we go through this particular presentation. I'll give you an example right here on any given week. It's just a random sampling. And what you're looking at are the final price targets that were determined right at the very beginning of the day, calculated the night before. And this is, again, as you all know, a business of being very approximately correct. And it is a business of correct approximations, and from there it's good money management. So what I have are three proprietary algorithms. And most everything that we do see out there quantitatively are reversion to the mean studies. This is really no different, but the question always has to be asked, reversion of the mean to what? These are not numbers off of a roulette wheel. We are looking at what I consider to be the best element to really consider, and that is the underlying valuation of, in this case, a liquid market asset. And the market or any individual stock will not meander very, very far away from its true underlying value before it will come back. So that becomes very specifically around which I build everything. Now, there's a valuation model we're going to be looking at, which leads to the high probability next day pricing. And for stocks, I used to be a currency and bond trader 30 years ago, but I found myself in the 90s looking at stocks because I could take, obviously, a common asset being equities. I can take a good number of them and then work an internal strength formula, which helps me, isn't necessary for other assets to be traded, but in the case of equities, it's just an additional wonderful element that adds to reducing the amount of risk on entry. Here's an example I've isolated just from the overnight. What you're looking at is the previous day, the night session, and the day session. And what I've done is at the end of the previous day, I will pinpoint both to the upside and downside, the nearby to the most extreme prices if the market ends up being a very strong day. Now, I give you both the up and downside because, during the night, there will be times when you will find that the market will go in one direction, but during the day session goes entirely in a different direction. Now, as you can see on this particular day, it meandered itself toward the first nearby down target. Now, in the morning, oftentimes even before the market begins in the just before the opening session, but certainly in the opening session, the strength formula, which we will take a look at here shortly, determines which are the irrelevant price levels. In this case, the extremes were out of the question. They were taken off the table, and this is the way the day session ended up. And as you can see, it really went towards the two midpoint prices, both to the downside and to the upside, and found themselves gravitating towards these inner prices, which are accomplished by a volatility calculation, which I incorporate in the formula. We'll take a look at an individual stock, in this case Microsoft. What you're looking at the bottom is the valuation model, the base algorithm, and we'll get into the details of it. Don't have to get into the construction of that study on the bottom at this particular point, but the point of it is that it's like flying at just several thousand feet and getting a good lay of the land. You once you get into the lower or upper standard deviations, you're in the game. You are at a point where you are very approximately correct and can reduce your risk. What you're looking at right now is a bit of a divergence, and when divergences with this study are set up, it really is a setup for a good, strong, solid move, which you can take advantage with both the underlying asset or options, be it on the long or side before the move or once it's made the move, being able to collect premium. I apply that to the S&P as a whole because obviously it is a portfolio. We'll be taking a look at some conventional studies which complement very well in picking up partial positions and trading what I call trading the mean. Now, here's a picture over a month's time of price target levels that were all calculated before those days occurred. And I want to zero in right now on this extreme day right here. In order to give you an idea of the strength study. By the beginning of the day, the upper targets were completely out of the question. We were only dealing with the lower three, and the internal strength at this juncture of the day, where you see that highlighted, was already determined that this lower target was going to be reached well before that move was made. And statistically, that's about as far. It could have gone a little further, but by that level, I knew that this was the end of the move for the day. And from there, I bring in, during the day, a standard deviation of the strength formula, which enables me to pick up, and we'll go into a lot of detail on this, where to pick up entries, in this case, on that day, on the short side. At the end, going near the end of the day, when it got to the bottom, put this price target level in its context of this entire month's move. And when you combine the valuation with the target and the internal strength, it's a very, very accurate and very powerful system. So I hope that you will take advantage of the 30-day free trial. No credit card information needed. You'll be informed at the time your 30 days is up. You will be informed that if you wish to continue. I am keeping it at $49 a month, cancelable at any time. For those who will become members and maintain their membership through 2010, when I am having this entire algorithm and methodology programmed on an independent database and software system, that when it is out, it will be very, very powerful in that you will be able to take any portfolio uniquely of your own and be able to develop these algorithms and even black box them, if you will. In the beginning, what we're going to be doing is you will be every day on a live webinar with me, and in your membership, when you log on, you will be given at the end of every day the next day's prices for our major indexes and a number of the most popular Forex markets. And as we roll out the final product, you will be able to look up anything traded on any exchange and be able to, construct your own portfolios. With that, I look forward to hopefully seeing you during the day sessions, and if you would just fill in on the text boxes where indicated. Thank you very much for listening to Next Day Pricing.